G'day traders, how are we all? So the ESMA changes have taken into effect and I'm going to drop my 2 cents via way of this video in regards to it. Now ESMA doesn't actually refer to the changes, okay? I've seen articles and videos and people have sent me emails in regards to this. ESMA is the regulatory body that has made the regulatory changes. Um, it's the European Securities and Markets Authority. Okay, so the changes have come into play at the end of July, and so if you are living in the European Union, then chances are you're being affected by this. Now, the biggest change to all of you guys would be the change in leverage. So if you're more comfortable, familiar with trading at 400 to 1 leverage, especially for majors and cross pairs. That's now been reduced to 30 to 1 for majors and 20 to 1 for cross pairs. And if you love trading gold, that's another problem because I think that's been reduced down to 10 to 1. Now, the idea here is to, one, bring it more in line with what's allowed when you're trading equities. And also, I think this is their poor way of trying to counteract or counter scams that exist within the whole forex trading industry. I think it's a stupid decision. I don't think this works. Also, it is their way of protecting you from yourself. Now, in that argument, I somewhat agree with them because I've had my fair share of traders that have approached me and they've traded like maniacs, and even after my advice they go back and do exactly the same thing again. And in some ways this may force them to reduce the number of lots that they're doing based off whatever their account balance is. But the flip side is also true, whereby if a person is a gambler and that's how they're approaching forex, it's not going to stop them from being more of a gambler. They will probably source money from somewhere, larger amounts of it now based off the requirements, dump it into their accounts and blow that. It's not going to stop people from being gamblers. So I don't see the whole point of this nonsense. They've got a number of other stuff out there as well. So there's a negative account protection that's in there, which in a way is a good thing, but no one should actually be in a situation where you have the ability to go into negative account, right? Yes, there are situations where, and the whole idea there is that because there is more fundamental impact on the markets these days, especially when there's trade wars and stuff flying around, that you've got the potential where something is said and in the next candle where the market just balloons out in the opposite direction, 50 to 100 pips or whatever it may be, and in doing so, that would actually result in you not only blowing your account, but if the trade doesn't close quickly enough, that could actually push you out into a negative balance. So this new change will actually protect you from that. And then there's the additional 50% rule to that as well. And what that basically means is this. So they call it the 50% margin rule. In actual fact, what it means is that, say for instance, you've got a £10,000 account, right? And you are trading pound USD currency pair at 1 for lot. Under the new changes, the required margin there, which would be 3.33%, would mean that you would have to put out a margin of $3,330, right? Or $3,333. So the 50% rule just basically says that when, say for instance, the market's going against you and you have blown 8,400 or something of that sort, and you've only got 1,666 left in your account in equity, at that point in time, the broker is legally obliged to automatically close off your trade to lock in your losses. So in order to protect whatever account balance you've got left, which would be 50% of whatever the required margin was for the trade you took, right? So what does that do? In actual fact, in terms of benefit to the trader, I have no idea. But I'm sure that it goes a long way to protect you from a negative account balance, right? That's one thing. Let's have a look at a calculator to kind of really drive home the point of what the changes have been. Now, I want to make it clear here that some of you might not be familiar with this. I've tried to make this clear in the Forex trading video, the Forex trading series, that when you're looking at trading different size lots, you're actually in the live market trading a significant amount of money. So say for instance, we've got our currency pair at pound USD and our account balance is in pounds as well. When we look here, when we're looking at the units, right, 100,000 units of the base currency, so in this case 100,000 pounds, is equivalent to one full lot in the live market. So when you're leveraging, what it basically means is that you are only putting out a small percentage in terms of a margin, which the broker takes as a security for you to be able to take that trade. But in the live market, it's the equivalent of the broker lending you whatever's remaining that makes up that whole 100,000 pounds for you to be able to take that trade. So in this case, if we were to do a leverage of 1-to-1, so you're not really borrowing anything, and you want to do a full lot trade, you would need 100,000 in terms of margin alone. This doesn't add equity or your overall account balance. This is just how much the minimum amount would be for your broker to take on as security in order for you to take a full lot trade. Now, the mini lots are 10,000 units. Micro lots are 1,000 units. So if you're doing a micro lot, which is 0.01, then that is 1,000 pounds. 0.1 is 10,000 pounds. And one full standard lot is 100,000. Okay? So let's do some calculations here. What's been going on up until now? Because many of you are probably trading at about 400 to 1. Okay? So at this stage, your required margin would have been 250 pounds. What's been happening is the broker takes that as security and then loans you 99,750 pounds. Okay, so that loan then goes out into the live market combined with this 250 that you've got there and then takes your trade. Now, say for instance again in terms of the 50% rule, if you only had 1,000 pounds in your account, then if the market was going to go against you and this amount here, not this amount in your account, you've already lost over 800 pounds. As soon as the amount remaining in your account as equity falls below the 125 pounds level, that trade would automatically be closed off. Now again, I say this, you should never be in a position where you're trading a huge percentage of your account to start off with in terms of margin, which results in you ever being, where a margin call is required. Please don't ever do that. So this is what the changes are now from that 400. If we were to go to 1 to 200, the margin requirement would be 500 pounds. Presently in the US, it's 50 to 1. So the margin requirement in order to do a full lot trade is 2,000. And the changes under ESMA is 3,333 pounds that you would need in order to do a full lot trade. So for those of you that have smaller accounts where you're really only trading 1,000 pounds or 2,000 pounds max, or even less at 500 pounds, you'd be restricted in terms of your lot size. And yes, as a result of that, you'd be restricted in terms of how much money comes back to you in terms of the number of pips. So you would end up having to collect more pips in order to get to the level of income that you're seeking. And again, it's a sucky thing because it really does price a lot of very sensible traders out of the market. Okay, now the rest of the ESMA changes you probably are already familiar with, so I'm not going to go into that. What does this actually mean overall? the first thing is, I think this is going to encourage more offshore operatives, and I'm not talking about people going to other regulatory markets like coming to Australia. I'm talking about where you're going to get a lot more of like scam brokers that will target people that are desperate to continue trading at the high leverage amount. So you'd have, probably even some of the binary options scammers out of Israel that will set up shop somewhere else in a low regulatory environment and offer you the 200-300 leverage, 200-300 to 1 leverage. Now, please don't do that. Don't fall victim to any of that sort of stuff. You will also have now some of these offshore operators be very, very ruthless in their marketing campaigns to try and get access to you, because this doesn't protect you being a European citizen. It just basically means any broker that's regulated within that whole European Union arena cannot offer you anything greater than what the law allows, right? We're also possibly going to see now some of the smaller ECNs drop out of the market. They'll probably go bankrupt. The reason is that by far the majority of profits that brokers tend to make comes from unskilled traders, newer traders that are trading the 250, the 500, £1,000 accounts. They're not from professional traders, right? Professional traders will claw back whatever losses they tend to make. So it's the traders, which also make up by far the bulk of traders, the smaller end retail traders, that will end up being hammered by this new regulation, and as a result of that, the brokers will lose the necessary revenue. So they're going to do a few things. One is they're going to really ramp up their campaigns to try and get professional traders on board, and I'm pretty sure they're going to kind of push some boundaries in regards to that. I think personally, what is going to happen, the smaller brokers are going to be they're going to go bankrupt, and you're going to see more of the market makers. These are the bigger brokers that do a mixture of ECN, plus they've got the dealer desks as well. So then the market makers will then capture the bulk of the market in terms of the sheer numbers of traders coming on board. Now, for them as well, what they're going to find is that as a result of the changes, they don't have as many traders doing the higher lot trades because they simply just don't have the money in their accounts. So what you're going to probably see is that within their platforms, there's going to be more spikes, more stop hunting happening in order to capture the revenue that they used to quite easily get before. Okay, so that's going to be a real problem in my opinion. You might also see some of the better brokers also establishing entities offshore, right? So, for example, one of the options for you guys would be to sign up with Think Markets. That's one of my bigger accounts right now. They're regulated in Australia. They do have FCA regulation in the UK. And so if you fall under the UK entity, then yes, you are you fall under the ESMA changes, but you do have the option to contact the broker and say to them, would you please put me under or move me under the Australian entity? They may require you to shut down your UK account and then withdraw all the money and then redeposit into the Australian entity and then sign up that way. They've also got a Bermuda entity as well. Now, as much as they may seem like a very good broker, you still want to cover yourself. And what I mean by that is that you don't know at what point any broker in the world is going to go belly up. You don't know at what point something's going to happen negatively with them that's going to affect whatever money you've got in your accounts, right? So I would at this stage recommend, if you are going to do something like this, transfer under the Australian entity and not the Bermuda entity. Okay. Now, downside to that is that ASIC may still look at doing the same thing as ESMA and CFTC and reducing the leverage. So we may have a pullback in Australia as well at some point, maybe in the next 12 months. I know that ASIC was looking into this back in 2013-14. We still haven't heard anything. There is a Royal Commission into banking that's happening right now, and I wouldn't be surprised if something happens in regards to Forex as well as an addition to the outcomes, the changes that comes out of the Royal Commission here in Australia. So we have another option. Now, this doesn't necessarily mean that leverage is gone forever when it comes to Forex. Yes, there's going to be providers somewhere. One of the better ones would then be Dukascopy Bank, which is in Switzerland. So I just want to clarify there's a difference. There is the Dukascopy European entity that's owned by the Swiss, but at the same time, you've got the Dukascopy Bank that is regulated under Swiss law in Switzerland, right? So they are they trade CFDs as well. These guys still allow binary. So Dukascopy, the leverage presently, the maximum leverage they offer is 200 to 1. So for those of you that would still like the benefit of the higher leverage without having to go through the process of becoming a professional trader, you can still do this. Now, in regards to the whole professional trader nonsense, basically there's 3 requirements there. And there are downsides to that as well, where you actually lose your account security in terms of negative protection. And plus, if you're a professional trader, you don't really have account protections in terms of your deposits. Some brokers will offer you that. By far, the majority of them don't. But on top of that, there are requirements. So you have to meet 2 of 3 criteria. One criteria would be to show them that you have $500,000 in liquid assets, right? Now, that only works if, in addition to that, you also show them that you've had at least 1 year's worth of experience within the financial sector. That's quite broad. I don't know how they would define that, whether you were a trader or whether you're an advisor or something along those lines. But it has to be more than 1 year. And in addition to that, it would be where you'd have to show, I think this is an either or, you'd have to show that you've done at least 10 major trades each quarter for the last 4 quarters, right? Now, what does a major trade mean there? That's not also clearly defined. We'd have to speak to the brokers about that. That may be, a 10-lot trade or more, 10 of them each quarter, and where you are profitable. That sort of stuff. I personally also will not be recommending anyone send in your accounts to justify that you have 500,000 in liquid assets if you do have that. Remember, be very mindful of who gets access to your financial information. Don't show people your account balances. Don't show people or share information in regards to the equities you hold. Don't show your bank statements to anyone. If at any point in time someone requires a bank statement to verify something, always have another account that's connected to your main account which has a lower balance, like maybe a couple of $1,000 in there, and take a snapshot of that, right? And then send them that, and make sure you're kind of covering out balances and things like that. Because again, there's a huge risk out there when we're sending our passports. We don't know how passport details, your license details, your proof of address and stuff. Yes, that's all tied in with the anti-money laundering laws, but I've seen numerous circumstances of that information not being securely stored somewhere. In actual fact, in certain jurisdictions, they shouldn't be storing it at all. They should just verify it and then gone, and they'll just have something on file that says it's been verified. But here in Australia, I've seen cases where some of the personal details have wound up in, say, Bangladesh somewhere, and you wonder how the hell did it make it all the way to there. So that sort of stuff, just be wary of that. Again, coming back into my recommendation to you guys, yes, if you are going to go offshore, look for a broker that is to some degree regulated. The Swiss and ASIC probably is the better way to go. The other thing is, here's your chance And this applies to everyone all over the world, because eventually all of the brokers, I think, will follow suit, right? Not brokers, sorry. All of the regulators will eventually follow suit. The thing that I want you guys to start doing is starting to treat this as a business. This has got to be a business for you. Start looking at making certain currency pairs your favorites. Maybe two or three of them max. Get to know those currency pairs really, really well. Get to know what fundamentals move those currency pairs, right? And if those two or three currency pairs are either, as an example, pound, euro, US dollar, and then yen, right? You're looking at those currencies. So you can make up pound USD, euro USD, euro JPY, pound JPY, something along those lines. Those are your two or three currency pairs. There's correlation between the majors, the USD pairs, and also the JPY pairs. And then start to understand how does the yen and the US dollar correlate with each other. So if there is an issue with the US dollar, then money's going to start flowing into the yen, right? That sort of stuff, and vice versa. US economy is strong, money starts flowing back into the US dollar. And this way you're only studying maybe 3 economies overall, and not kind of looking at so many currencies across the board. And then from that point on is when you're building your accounts, where you will have to get to a stage where you are, and I don't care if you go offshore now and you're trading at 200 to 1 or 400 to 1, I still want all of you now to start building your accounts to a minimum of about 10,000 of your base currency. That way, with these changes, at the bare minimum, you'll still be able to trade at 1 full lot, right? Minimum at 10,000. This is still 30% of your account balance, which really it shouldn't be. You want to increase it so you're utilizing less than 10%. I personally do about 5%. If it's a trade that I'm absolutely certain about, then I'd probably push 10%. But that also is based off experience from the past. If you're still a relatively new trader, then less than 5% would be ideal of what you're risking. Start working in that regards. Now, if you've got a smaller account, please don't be shy of moving down to doing a mini lot trade, right? So say for instance we're still at the 30 mark, we go to the mini lots. The amount that you would need in order to be able to trade that would be 333. So that's pretty similar to how much you would have had to pay out in terms of a full lot trade right now, right? So don't be shy in terms of pushing back towards a mini lot and then slowly grow your account that way. Remember, this is for the rest of your life. This isn't for, I'm going to do this for 5 months, become super rich, and then go do something else. This is just something in addition to everything else that you want to do in life that's going to get you a regular income coming through. At some point, yes, your account balance would have built up to a point where you're back at multiple standard lots, or even 5 lots or 10 lots in that regard. That will happen down the track. Yes, it sucks that they've done this now. You still have an opportunity to go offshore to the Swiss or to Australia, and then via that way grow your account. But I want you to become very business-like. Okay, please do this very business-like. Be selective of currency pairs. Be selective of your entries. Write down your entries. Write down every trade you take. Analyze them on a weekly basis. Take screenshots of your setups and study them on the weekends. Start looking at fundamentals and what they mean. Every time there is a specific fundamental news release happening, look at the markets and possibly avoid trading unless you're certain about what that release is going to be. Also, when you see government officials speaking, when you see central bank governors or a governor or a member of like the Monetary Policy Committee is going to speak, possibly don't trade then. So if you're trading the pound in particular and you see the Bank of England governor who's got a speech on, don't trade. Simply because you won't be clear on what this person is about to say When Carney goes out there, he's brutally, well, not brutally, but he is more honest than most other governors, right? And what I find is that, say for instance, with the last big release that the UK had, which was a rate hike, Carney actually came out and he said, here's the reason why this has happened. This is why, inflation has pushed up. This is why such and such has happened, and this has resulted in a rate hike. But in him saying that, the market reacts to that because the market knows, well, this was an empty rate hike that was necessary, but it doesn't actually show us the full strength of the economy. And as a result of it, you see a spike going up, but then that turns into a red candle, and then the market's on its way down again. So that sort of stuff. Personally, I think it would be better if you stayed out of the market and waited for that to complete before you looked at a possible entry. Okay, that's enough of what I needed to say in regards to this. All the best trading, guys.